All right, let's talk about something that almost no one is explaining clearly right now. And yet it could quietly change how much money stays in your pocket every single year. If you are 65 or older, or if you and your spouse are both over 65, I want you to slow down for a moment and really listen to this, because what we're about to cover is not noise, it's not political talk, and it's not one of those exaggerated online rumors. This is a real IRS rule already written into law that could protect thousands of dollars of your retirement income from federal taxes. And the reason this matters so much is simple. Most seniors are already doing everything right. You budget carefully. You plan ahead. You try not to touch savings unless you have to. So, when the government quietly changes how much of your income they tax without sending you a letter or making a big announcement, missing it can be expensive. Today, we're going to break this down slowly, clearly, and step by step. No confusing tax jargon, no rushing, no assumptions, just the facts and what they actually mean for you. Why this new IRS change matters right now. Here's the first thing you need to understand. This is not a small adjustment like the ones you see every year where numbers move slightly because of inflation. This is a new additional deduction created specifically for seniors. And unlike many tax changes that only help people with high incomes or complicated investments, this one was clearly designed for retirees living on fixed or modest incomes. That's why it's catching so many people off guard. It didn't come with loud headlines. It wasn't widely explained on TV, and many tax preparers haven't even started talking about it yet, but it's real and it's powerful. The number you should remember, let me give you one number right now, $6,000. If you're single and 65 or older, that's the potential extra deduction you may qualify for. Now here's the part that really makes people stop and pay attention. If you're married and both you and your spouse are 65 or older, that number doubles, $12,000. That's not a credit, that's not a loan, that's not something you pay back later. That's income the IRS may not tax at all, money that stays in your account. Hey everyone, welcome back to Rice Money Talks. Today we're diving deep into a new senior deduction that's creating real opportunities for retirees to keep more of their hard-earned money. Before we get started, if you find this information helpful, drop a comment below sharing your thoughts or any questions about your taxes, and make sure to like this video. It really helps us reach more seniors who can benefit. Now let's get into the details. So, what exactly is this new deduction? Officially, the name isn't as important as how it actually works. Many are calling it a senior bonus deduction, and the word bonus is key because this deduction doesn't replace anything you already get. It stacks on top of your other deductions. That means you still receive your standard deduction. You still get the extra age-based deduction for being over 65, and now this additional senior deduction may be added. Think of it like layers. Each layer protects more of your income from federal taxes, and that stacking effect is what makes this so powerful. Here's why stacking matters. Most people assume deductions are either or. Either you get this deduction or that one. But this rule works in addition to everything else you already have. That's rare in the tax code, and it's exactly why this change can dramatically lower taxable income for seniors. If you rely on Social Security, a small pension, IRA withdrawals, part-time income, or interest, all that income is counted when taxes are calculated, but deductions reduce the amount actually taxed. Let's walk through a simple example. No math stress here. Imagine a single retiree, age 67, with Social Security, a small IRA withdrawal, and maybe some interest income. Before this rule, only certain deductions applied. Now, with this additional senior deduction, thousands more dollars could be protected, potentially making the difference between owing taxes or owing nothing at all. This isn't just theoretical, this is real money that stays in your pocket. For many seniors, taxes appear higher not because income rises, but because deductions haven't kept pace. This rule helps fix that, at least temporarily. Yes, temporarily. This is very important. The deduction only applies to 4 tax years, 2025, 2026, 2027, and 2028. After that, unless Congress extends it, it's gone. That limited window means the timing of your IRA withdrawals, Social Security, and other income could matter more than ever. Planning smartly over the next 4 years could save significant money. Who is this really designed to help? Not millionaires. This deduction targets middle-income retirees, seniors on fixed incomes, and those feeling squeezed by rising living costs. Income limits apply, but even if you earn more than the lowest thresholds, you may still qualify for a partial deduction, and partial is still real savings. Now let's clarify what this deduction does and does not do. It doesn't magically make Social Security tax-free. Anyone saying that is wrong. Social Security tax rules themselves haven't changed. However, by lowering your overall taxable income, this deduction can reduce how much of your Social Security ends up being taxed. It's an indirect effect, but it can be very real and significant. And here's something seniors need to understand. The IRS doesn't automatically apply this deduction. You must claim it correctly. Filing the wrong form or missing a checkbox could leave money on the table, and once a tax year passes, correcting it can be stressful. That's why awareness is crucial. And yes, whenever there's a new benefit for seniors, scammers appear. They'll call, email, or send letters offering special help for a fee. Ignore them. You don't need to pay anyone. IRS forms are free, and reputable tax software will guide you. I'll explain exactly how to claim it in a moment, so stay tuned. Here's why this deduction is so impactful. Even a few $1,000s in deductions can make a noticeable difference. Reducing taxable income could keep you out of a higher tax bracket, lower Medicare premiums, and reduce how much Social Security is taxed. For retirees, that can mean more cash for prescription costs, utilities, or emergencies. It's real, tangible relief. Let's get into income limits. This deduction primarily helps low and middle-income seniors. For single filers 65 or older, the full deduction is available up to $75,000 of income, starts phasing out above $75,000, and disappears completely at $175,000. For married couples both 65 or older, the full deduction is available up to $150,000, begins phasing out above that, and ends at $250,000. If your income is below these thresholds, you may qualify for the full deduction. If it's in between, you could still qualify for a partial amount, and every dollar still reduces your taxable income. Here's a simple way the phase-out works. For every $1,000 above the threshold, the deduction reduces by $60. For example, if you're single, 68, with $85,000 in income, that's $10,000 over the $75,000 threshold. Divide $10,000 by $1,000 to get 10, then multiply by $60, which equals $600. So if the deduction is $6,000, it's reduced by $600. You still get $5,400 to lower your taxable income. Partial deductions are still meaningful. This applies even if you're working part-time. Many seniors freelance, do seasonal work, or have contract jobs. As long as you're 65 or older and your income stays within limits, you qualify. You don't have to be fully retired. Another benefit is flexibility. Normally, you must choose between the standard deduction or itemizing. This senior deduction works with either option, meaning it adds value regardless of your tax strategy. You don't have to rearrange your finances just to claim it. Here's how to claim it correctly. Step 1. Use the proper tax form 1040SR designed for seniors. Step 2. Confirm your age with the checkbox for 65 or older. This matters more than people realize. Step 3. Complete the additional schedule for the senior deduction. Most tax software guides you automatically if you enter your information correctly. If you use a preparer, ask them directly to include this deduction. Don't assume they know. Let's clear up the biggest rumor. This deduction doesn't automatically eliminate Social Security taxes. What it does is reduce taxable income, which can indirectly lower how much Social Security is taxed, sometimes even to zero. Understanding this distinction prevents costly mistakes. In real terms, if you qualify for a $6,000 deduction and are in the 22% tax bracket, that's about $1,320 saved. For married couples with $12,000 in deductions, the savings can be even higher. For seniors on fixed incomes, this is meaningful relief that can cover essential costs. Timing matters. Remember, this deduction expires after 2028 unless extended. Over the next 4 years, the timing of IRA withdrawals, Social Security, and part-time income can influence how much you save. This isn't about exploiting loopholes. It's about smart planning with the rules as they exist. And a final word on scams. Anyone promising special IRS filing help for a fee is lying. Legitimate software and professionals don't pressure you or ask for unnecessary payment. Stay alert, file correctly, and you'll get the benefits you deserve. If you found this useful, drop a comment below sharing how you plan to take advantage of this deduction or if you have questions about your situation. Liking this video helps other seniors discover this important information, so please hit that like button. That's the full breakdown of the new senior deduction, how it stacks with your existing deductions, who it helps, how the phase-outs work, and how to claim it properly. This is not just about taxes. It's about giving seniors breathing room in a tight financial world, keeping more of your money where it belongs, in your pocket. If you haven't already, make sure to subscribe to Rice Money Talks and hit the notification bell so you don't miss part 2, where we go step by step on exactly how to file and claim this deduction correctly. Trust me, you don't want to miss it. Thanks for watching, and I'll see you in the next video.